Money. Money.
Tina Mitchell here with your Money Chat. Volatility in the bond market came after Jerome Powell gave his semi-annual testimony in front of the House. He gave support for a 25 basis points hike instead of the 50 basis point hike. This means that the Fed is going to address inflation less, even in the face of rapidly rising, especially with oil now rising sharply at 113 a barrel. He also said that the Fed will need to be nimble and careful because of a highly uncertain geopolitical background. It brings into question if the Fed will have the resolve to continue to hike and tame inflation. As a result of the Fed appearing less aggressive, stocks rallied and bonds plummeted. It's been crazy in the mortgage industry, how the mortgage interest rates have been moving up and down. Now, because of the dollar remains the most accepted and stable worldwide currency, the international community uses it as a preferred currency for trading and purchases of goods and services. The world is currently witnessing a run off of the banks in Russia, and somewhat similar to what took place in the U.S. immediately following the stock market crash of 1929. Citizens are flocking to ATMs or trying to pull out money to put into the U.S. or euro assets, which will protect them from the ruble declines. Recently, the ruble has seen significant declines, and these declines will have impacts in our global economy for quite some time. Russia is trying to prevent an outright collapse of the ruble by raising rates. The central bank rate went from 9.5% to 20% overnight, which is more than 1,000 basis points of hikes. And here in the US, we're only talking about a 0.25% hike in this month. This is a serious situation. Now, the Russian currency and the central bank, and it's kind of the jury's still out in how they're going to solve and what's going to happen with this. On another front, international job claims, which measures individuals filing for unemployment benefits for the first time, decreased 18,000 to 215,000. Continued claims, which are those that continue to receive benefits after their initial claim, increased 2,000 to 1.48 million, which is just off of the lowest since 1970. Claims are very strong pre-COVID level, showing that the labor market remains tight. Now, in the housing news, pending home sales, which measures signed contracts on existing homes, fell 5.7% in January, which is weaker than expected. Last month's reading was revised higher, and when factoring in that, it's down closer to about 4%. Sales are now down 9.5% year over year. There is no doubt that higher interest rates could be impacting demand, but the real story here is the lack of inventory. There were only 860,000 homes for sale last month nationwide. If there were more homes for sale, there would be more sales. New home sales, which measures signed contracts on new homes, were down 4.5% in January at 801,000 units analyzed pace, which was much stronger than expectations of 8.6% decline. There was a positive revision in December reading, and when factoring that in, sales were down only around 1%. Year over year, sales down 19%. Now, with the rise in home prices, some buyers may think it's a better option to rent, but Apartment List released their February national rental report showing that rents rose 0.6% in February, which is a reactualization after the fewer months are slowing down increases. Now, on a year-over-year rent basis are now 17.6%, almost matching the rise in home price appreciation. Rents can continue to rise on renewals each year, which are currently going up 6 to 8%. Renters also do not get to see the benefit of amortization, the amortization on appreciation or in the appreciation. So call to action, homeownership is a great investment. And that is your Money Chat.